All right. Good morning, everybody. I think the name of the title pretty much gives it all away. This seems like a market waiting on a catalyst. Kind of like, the old phrase, give me an excuse, give me a reason. That's what it looks like this morning. Bitcoin moving around a little bit in the pre-market, and so are the companies connected with it. So, as usual, we want to start out at the FX calendar. This is FX Street. It's free. You don't have to buy anything. Just swing by there and take a look. Careful, you got the ECB chip in her teeth this morning. And you can see it's got an elevated impact expectation. Relatively decent moves in the dollar and the bond. We'll get into that, though. And otherwise, not a whole lot on the agenda. Bring it over to Thinkorswim. Go to the Market Watch calendar. If yours isn't all nice and clean and looking like this and it's full of junk, just uncheck the show all, turn on Econo Day event. I like to grab that description, kind of bring it across, set it next to the time. Additional auctions at 11:30 today. Be very, very careful at 11:30. I can't tell you how many times I've seen the market completely change course right at 11:30. Right at one of these additional auctions. We sometimes get them at 1 o'clock and 11 o'clock as well. But today, 11:30. So be on your toes with that. And then consumer credit, investor movement index. So 11:30, 12:30, and 3 o'clock. It's unlikely that the numbers we're going to see this afternoon will have impact through the rest of the week, but it is likely that they could have impact today, right? You kind of want to look at the bigger picture when it comes to these and where our expectations go for the kind of news that we're going to get. All right, so taking a look here at the S&P. Oh, we're not on the S&P. Got a little bit of volatility. Today's one-day expected move is $40. For the week, we're looking at around $100. You can see the expected move where it says top and bottom. Kind of puts us beyond the range of last week. If we were to look at that on the higher time frame, it's outside of the entire week. So a whole lot of nothing. We're sitting sideways, just kind of maintaining this range. On a day like this where we're going nowhere, a channel band would really be useful to help you in your trading. Something like acceleration band, Keltner band, Bollinger, just something with some bands on it, right? No reason to overcomplicate things. One standard deviation, maybe load the bands more than once. Put on a 1, a 2, give it an outlier and put on a 3. And then just play the range with some kind of divergence, money flow, OBV. No reason to overcomplicate things. It's very unlikely we're going to leave this range without some news. Keep in mind there's this theory about the market that everything is already priced in. And I can understand that to a point, but we've been closed all weekend and it needs to price in all of the news from the weekend, right? So on Mondays, especially, But on any day of the week, when we get into the open, the market's got to price in the overnight news. This can, take anywhere from 20 minutes to 2 hours. It just takes time to absorb and price in the news over the weekend. The institutional pivot points are going to be in play today. So any break to the upside, we got to get through our own Globex high. We'll challenge yesterday's high, and then we'll deal with the Thursday high in that Globex. Move to the downside, we'll re-challenge our own Globex low, and then make a run for yesterday's low. There's nothing else until we get down to around 4,400. So if we do break yesterday's low, go big, right? Don't be looking for the nickel and dime play. Take it on the run. For the NASDAQ, it's exactly the same story, exactly the same setup, everything. We could pretty much take our notes from the S&P and set them right over here. And one thing I wanted to point out, when I was going through reports over the weekend, Bank of America came out with their January report. And in that January report, when they were monitoring the flows, all the buy the dip players in January were retailers, and the institutions were liquidating their positions. Why is this important? Well, when we started topping out back here and everybody started to get nervous about a Corona crash 2.0, I had pointed out that it was very unlikely because everybody was carrying insurance. Anybody who knew how to do it was carrying insurance. They had no reason to sell because they had no fear. The reason that things really crashed back during the corona is because the institutions weren't carrying very much insurance. It costs a lot of money to carry insurance, and if they don't need it, they won't get it. They try to squeak that line between having just enough for really bad times and then not having enough, right? And it's always a difficult needle to thread. But they had gotten kind of lax, and there was a lot of stories that kind of went into that. They had gotten lax, and as we came into that new year and the corona news started piling up and we started to dump, they were getting margin calls they need to cover. There was people running redemptions, and it was just a big selling spree. Well, of course, after we started coming back out of that in March, they were all hedged up at that point, and they've stayed hedged since then, spending way more money than they normally would to protect their positioning so that they didn't have to get back out of everything again. They're liquidating right now, not because they're scared, but in a systematic, very controlled way. They are liquidating all of their positions because, like I mentioned, it's very expensive to carry a lot of hedges, right? You're better off just rotating out if you see that, say, for an example, we're going to get a change in policy, right? They've got a long-term reason to start rotating out. It's that whole growth value argument, and then they're rotating into different sectors. So they don't need the insurance. They're liquidating out, and the only ones holding the bag right now are the uninformed retailers, most of which who do not run hedges. So if things start to get nasty, like they have been since August, September, and this whole topping pattern through November and December, the retails are going to just dump this stuff because they're not hedged. And you can't go get insurance in the middle of a house fire, right? You got to have the insurance before the house fire. Once it already starts to get bad, it's too late. It's too expensive. The cost of the hedge alone would be so great that it becomes a source of its own risk. But I did find it interesting that the flows point very, very specifically at retailers buying this dip. Something to keep in mind. All right, bring in the other markets we generally look at. So you can see that significant move on Friday. The 10-year, and the 30-year, the dollar. Keep your eye on these two today, especially with the news kind of being as dull as it is. The market really is looking for a reason, right? And last week there were two records set. The greatest fall and money outflows in a company, that was Facebook, and the greatest flows of a company to the upside, that was Amazon. We're setting records in price movement due to the volatility. The current market conditions are just so extremely violent that the moves are magnified and exaggerated. When you're watching these two, keep your eye between the dollar and the VIX. We want to make sure that they're not beginning to correlate. We use the dollar a lot of times to gauge global risk. So if institutions around the world start to get a little nervous, we want to get into a risk off situation, they'll move into the dollar. And when they do that, the dollar will start moving very similar to the VIX. So we want to look to see if they're beginning to decouple or not, if they're moving inverse of each other, or if their charts start to look very similar. All right, crypto's moving around quite a bit this morning. It was the one thing that was triggering all of my 1.5% and 2% pre-market scanners. When it comes to the crypto list, I got this list of names from the Smalls Exchange crypto futures product. Right, I didn't just pull these names out of thin air. If you're trying to recognize a sector, a subsector, an industry, the easiest way to do that is to lean into where somebody else has already done all the work. So these names aren't individual crypto coin. They're companies that are in some way connected to blockchain. Financials are kind of doing okay this morning. And like I've mentioned before more than once, we got to have financials and we got to have tech, one or the other. Two combined would be better, right? It's one individually can kind of keep us going, but you get both of them, you get a really good trend day. So we're starting to get some of those financials coming online, but keep track of which of the financials it is, right? Because we have to be more specific than just say something like, "Oh, it's the financials." Credit cards, lending institutions, insurance. We got the devil's metal, gold, the marijuana sector, Bitcoin, a, a very small amount of tech. And remember, once we start getting below 0.5%, I really kind of consider it negligible, right? It's a minute amount if we're not up at least 0.5%. Energy is down quite a bit. That's going to be a big part of my focus this morning, looking for energy to turn around. Now you can see we're starting to come off of those lows. We closed relatively well on Friday. Then we started to fade down in the overnight hours. We got this beautiful topping pattern here with a really nice rejection on Friday. Now, I don't think we're headed down yet today. I don't think we're going to, uh, just start really working down towards that 95 level. But the range is really wide from Friday. And we kind of just want to see if we can maintain inside of that range. And if we dump down in it, we're going to be inside day from these two previous candles. We've still got the monster shadow candle running from like 112 to 104, 105. So really big range to play in. There it is. When you're looking at energy, you want to break them apart just like finance, right? Put them in their own categories. There's a lot of different energy out there. Cost wise and liquidity, energy's been a really good play most of last year, so far this year. The way I would like to do it on a day like this, focus on something like energy that's down but maintaining. They've got a really good daily chart, nice setups. That's going to most likely carry the most of my focus. Uh, the cloud computing, IGV, a lot of charts that have this pattern where we're sitting kind of at those lows. That green candle from Friday, a lot of them are showing a reversal setup, a reversal candle. It's a good size green candle closing near the middle of the body, near the middle of the range, with a long wick on top. It's a reversal pattern. So, we've got this indecision market, indecision candle, indecision setup. It's like make or break time. Most of the sectors that I'm flipping through have this setup. So when we look at something like energy, it stands out, right? Because it's got something different. Even on these gap down daily sectors like XLB, we had a gap down and it tried to kind of recover a little bit, a lot of wick on each side. There's no real show out volume here. Right? I mean, it had a little bit of elevated volume, but not enough, right? If we're looking to call bottoms, it would be some kind of volume like this, and it would be a massive gap down day, and then a tremendous rally throughout that day with a large volume bar. That Monday was a really great example of that. That's the kind of market day that we use to call a bottom. But when we call bottoms, it's not just that one candle and that little bit of volume. There's a lot of other things, right? The whole checklist. That's just one piece of the checklist. So after that Monday, when we didn't really get the follow through we were looking for, and we're starting to see these gap downs, we're not getting that recovery back up again. And or we're getting things like communications sector where we have this indecision candle or this reversal candle. So just be very cautious. Right? So energy, natural gas, emerging markets, healthcare, they're all flat to negative. Utilities, that's about what I got, guys. Be careful, be safe. Check out the COT report, the commitment of traders. I didn't do a video on it, but there was a lot of insight on this over the weekend. TradingView does this now. They have the commitment of traders report. I haven't gone over and checked out TradingView's version. Normally, I go to uh, Trading Stir. They have uh, better charts than what you get from the government. Still the same data, it's just presented differently. It's a lot of insight in there from over the weekend, worth checking out. Just remember when the data is coming out that you're reading about. So, looking at the data from a daily chart perspective, the data comes out on Tuesdays. Excuse me. The data is collected on Tuesdays. It is published on Fridays. So on Tuesday, they take a week's worth of data and they give it to the government, right? Which means even though the data was collected on February 1? Yeah. The data was collected on February 1, but the data inside that was for the previous week. Now, if you're thinking, well, that's a long time ago, that's worthless data, it's not going to help me out. It takes the institutions a significant period of time to readjust their position. Right? They're not as nimble as we are. It takes them time to unwind, kind of rebuild positions. I will see you all in the large caps at no, I think today I'm in the futures room. So I will see you all in the futures room. Yep, I'm in the futures. All right, so I'll see you all there at quarter after 9, I guess.